Welcome back to The Sweet Life. First thing I do every day is I check my accounts. I pull this up and I'm like, whoa, dang, that went down low. What just happened? And then I realized it's all due to AT&T. They finally did the deal with Warner Brothers. They're now split off. In fact, if you're an AT&T holder, here's what you should see. You should see your normal AT&T shares. And then if you go down below, you should see an equivalent of your Warner Brothers Discovery stock. Now entirely separated as two different companies. But we need to discuss a few things. One, now that AT&T is strictly a telecommunications company, what can we expect? Is this time to now sell AT&T or hold on? And then we also need to look into Warner Brothers a little bit and talk about this entire thing that just happened. Now, I did a video and it felt like it was just yesterday. I went to see when I did this video on AT&T and oh my gosh, it was back in May of 2021. It's almost 1 year ago. What happened to the time? But in that one video, I said this. With average trading volume of 33 million, just imagine what that's gonna do to AT&T. If it has volume of 61 million shares being offloaded by all the ETFs, this price will fall fast. You just gotta understand that that's gonna happen. You gotta hang on for the ride. And that is exactly what happened today. Now, in my Robinhood account, what I expect to see, of course, is right now, WBD is listed as NA. They're still purging that information in. So I expect, because I have not sold anything, for that little chart right there to go back up to a normal level once they get that situated. But first of all, let's talk about the news, and then we're gonna go and dig under the hood to see what's going on with AT&T, and I wanna compare it today to T-Mobile and what the deal is. If this one is totally screwed because they offloaded Warner Brothers, or if there's a potential hope for the future, and let's talk about their dividend too. So first thing, let's look at what we came to talk about, which was Warner Brothers. So today, officially, AT&T announced that they have closed their transaction to combine Warner Media business with Discovery, hence WBD, Warner Brothers Discovery. This happens Monday, April 11th, today, and it's now under the new ticker symbol WBD. Now, I will do a stock analysis on this particular one once we get some data, some revenue, and some financials behind this company. So make sure you subscribe for more if you're interested in that kind of thing. So what's really nice about this is now we have what used to be AT&T, right? AT&T had the telecommunications company, internet, cell phone, broadband, blah, blah, blah. But then they also had Warner Media. In the Warner Media portfolio, you had things like HBO, CNN, and that was why I think a lot of people were initially bullish on AT&T. On top of the fact that they paid an incredible dividend, about 6 or 7% dividend yield on their particular shares. They were also a dividend aristocrat. They've been paying dividends and increasing their dividends for a very long period of time until they decided that they're splitting off from Warner Media. They're going to merge that with Discovery, push it to the side, cut their dividend, and then ever since that announcement last year, the stock has just gone down, down, down. And then of course today it fell off the cliff as a result of purging them out. But really the question has to become, is this still hope for the future? Let's dig under the hood and show me the money. So what's really cool about this one in particular today, unlike the other ones that I do, I'm actually gonna do a head-to-head. AT&T, TMUS. TMUS stands for T-Mobile. We're gonna go them head-to-head and see what's going on. First things first, PE ratio, we like anywhere from 15 to 18, 20, something like that. PE ratio is price to earnings ratio. Right now, for AT&T, we're sitting at a 711. That is a little bit low, so that's kind of interesting. But then if we look at T-Mobile, that's sitting at 54.61. So because we have a low and a high in these particular examples, right off the bat, we're gonna say that both of these deserve a bit of a yellow light. So AT&T is gonna go right here. T-Mobile will go right here under where it says TMUS. Please don't judge my handwriting. I'm still learning how to do that. Next up, let's talk about revenue. Now, we want to see revenue grow over time if we do proper fundamental analysis. And if you're an AT&T shareholder, you want to be interested in this stuff. Because if you're not interested in this stuff, you might find yourself in a very bad situation where your eye's not on the game, and then you're wondering why the share is going down, down, down. Always keep your eyes on the news and always keep your eye on these fundamentals. So I'm going to share with you how exactly I do that. Right now, I've been using significantly finance.yahoo.com and then also Webull just because it's easy to do. So in Webull, all I have to do is go over to the watch list on the app, click on the little magnifying glass, and then type in AT&T. So let's go through all of these with AT&T, and then we'll go through T-Mobile and see how they stack up. So first thing is revenue. Come down here in the income statement and hit total revenue, and that'll show you what's going on. So what we want to see is increase over time. 2017, 160 billion. followed by 170 billion, followed by 181 billion, 171, 168. It's going down. So because it's going down, there's two ways you can handle this. You could say that's a red light because you need to keep your eye on why their revenue is dropping, or you could say it's a yellow light because you understand that they're offloading Warner Media. And that's an obvious mathematical ordeal. Communications made up a very big part of AT&T's overall revenue. In fact, I mentioned that in one of my prior videos. On the March 31st, 2019 statement, you can see operating revenues at 27 for communications and for Warner Media at 8.7. So, and of course that's in millions, but that's an important thing to think about. Most of it is coming from communications, which could be kind of a cool thing to think about when it comes down to what we'll see in the long term. So what that all means is I'm going to give revenue a yellow light only because I understand what's going on with Warner Media and I want to see communications, the overall core of the business, continue to go back up. Let's go on to profit margin. And to find out profit margin, we're going to take the net income divided by the total revenue. So right here we are in Webull, net income of, what does that say? 21.48 billion. So in the calculator, I'm simply just going to type in 21.48, and we're going to divide that by total revenue by clicking right there where it says total revenue and 168.86. That gives us a 12.7% profit margin. Now, a 12.7% profit margin is pretty darn poor. Now, I'm going to give them a little bit of a red mark here. I'm going to give them a red light for profit margin. I want to see that continue to go up. It could be yellow because, again, we could keep giving them these little benefits of the fact that they just offloaded Warner Media, but I'm going to give them red because I'm keeping an eye on that profit margin. And what I want to see is that as we go through the rest of this year, I want to look at Q3. I especially want to look at Q4 of 2022, and I want to see profit margins increasing in AT&T. I want to see revenue increasing in AT&T and everything in between. Let's go on to debt load. Debt is important in any type of company. You want to make sure that their balance sheet isn't completely out of whack. And right here we are. Now, of course, this is going to be reflective of Warner Media, but if you look at it, 551.62 billion versus liabilities of 367.77, that is a 66%. I like to see 50% or lower, so I'll give that a yellow because, I want to see that debt continue to go down. Now, what we could continue to see is that their assets keep growing and their liabilities go down, and if that's the case, that's great, but I want to see this debt go to 50% or less for the type of company that this is. It's got to be balanced. Earnings per share, all you do is scroll all the way to the top of the financial statement. And of course, this is going to also look a little bit strange, but what we want to do and what I would recommend you do is in your Webull app, keep an eye on Q1 2022. When those earnings are announced, we want to see that go above the gray line because you can see the gray line, the estimate has gone up a little bit. We want the blue line to not fall underneath that. It likely could as a result of what we're seeing here today. But Q2, Q3, Q4, that blue line better as heck be above the gray line, and that will, as it does right now, continue to give them a green light in earnings per share. All is fine there. Now, one thing I don't like about Webull is I can't find a good, accurate reflection, even when I click on the balance sheet details of their shares outstanding, and I think that's really important because shares outstanding is what's going to continue to drive a price better or worse than where it is today. So in order to do that, we got to go over to Yahoo Finance to find the last thing here, which is shares, which means shares outstanding. Go over to where it says financials, click on that. And then what we're going to do is we're going to click on where it says balance sheet, click on that. And then right here at the bottom, you're going to see ordinary shares. And we want to see this number continue to go down. Now, they were doing a good job. They were doing a good job. If you look here in 2018 versus 2019, we went from 7.2 down to 7.254, down to 7.1, and then they did increase this a little bit to a 7.14. What we want to see, especially now that they're going to get a lot of money back from the Warner Media deal, we want to see the total shares outstanding dropping significantly. So I'm going to give them a yellow light there. Now, this looks pretty poor for AT&T, does it not? But that's why we need to keep a close eye on it. They just changed the game in their stock. What's this going to look like? Let's take a look at T-Mobile though and see how it stacks up. And the goal, in my opinion, again, this is not financial advice. I'm just showing you what I do when I'm taking a look at different stock fundamentals. My idea here is to help you with the tools that you can do it yourself because this could change every single day. And if it changes and you're not on top of the game and you're referencing a video from a long time ago, you could get yourself into big trouble and you can't do that. So take this, for doing your own research. T-Mobile, go to the company, go to financial details, let's stack it up. Now, what we want to see is AT&T look similar to T-Mobile over the long period of time. If this continues to go favorably for them, this could be a good thing. If, of course, T-Mobile is looking good, total revenue. So, wow, this looks pretty good. 40 to 43 to 45 to 68 to 80. The revenue continues to increase. Looking pretty darn good. That's an obvious green light because the revenue continues to improve. And not only that, if you look at this, 6%, 3%. The surge in 2020, we could credit the pandemic for that at a 52% increase in revenue, and then a 17%. We want to continue to see green and upward momentum. So that's kind of what I'm looking at for that. Let's look at profit margin again. That is your net income divided by total revenue. So we're going to take 3.02, which stands for 3.02 billion, and we're going to divide that by 80.12. That gives us 3.76%. So that's a red light. That's a really bad profit margin. T-Mobile, come on, get your act together. You're spending too much. You're spending too much with your operating income. And, I want to see a little bit more out of that. I mean, to get 80.12 billion in total revenue and then your net income of only 3 billion, that's kind of sick. What are you guys doing over there? Keep an eye on that. Debt, let's look at the debt load. Okay, debt load's looking okay. 66%, that gives them immediately a yellow light because I want to see that at 50% or lower. So, not looking good. But overall, though, they do have 206 billion in assets, 137 billion in liabilities. They sell all of their liabilities. They will still be profitable, but again, a little bit high on the debt load, especially for a telecommunications company. Earnings per share, let's go to the top. You can see the blue line. Even though Q3 2021 does look a little bit like it met the estimate, we are still above the estimate or right at it. So that looks pretty good, and we'll give that a green light. And then shares outstanding, let's hop back to our favorite, which is Yahoo Finance. Let's go over here to Financials tab, and then once again, click on Balance Sheet and scroll to the bottom. So shares issued and ordinary shares. Okay, so we went from 850 to 856 to 1.24 to 1.249. They continue to issue more shares. Knock that off. I want to see your overall value go up. That's a yellow light. So here's what we have going on. Things are kind of similar, except for revenue, okay? Profit margin is terrible in both of these companies. Now, what AT&T could do is really manage their profit correctly. And if they do that, they could kick T-Mobile's butt in this particular sector, which that would give, I think, a lot of different institutions, a lot of different stock investors AT&T is really getting with the game. That could be a good thing. And plus, remember, we have Verizon Wireless that, is a very big company. We want to see this continue to improve. Debt load. Let's get our debt in order. They're both a yellow light. Earnings per share look great, and then shares outstanding. AT&T could really take the crown for this if they do the right thing with what they're about to get as a result of the split of the Warner Media outlet. Now, what to expect out of AT&T and WBD if you're a shareholder of both as a result of this split? I think there's a couple things that could happen. First of all, the Warner Media stock may actually go down a little bit as a result of some of the AT&T shareholders selling it off for a potential view of profit and then taking it from there. I don't know. Personally, I think I'm going to hold both because, first of all, I never want to sell on a red unless AT&T announces that they're going bankrupt and that they're completely screwed. To me, I hate selling at a loss. So that's personally what I do. I kind of hold until I see green happen. And then at that point, I want to look under the hood and see if they're doing even better with their overall fundamentals. What are your thoughts on AT&T and its future? What are your thoughts on Warner Brothers? Comment down below and let me know. Check out this video next, and we'll see you on the next video.